In part 2 on identifying manipulation levels, we're going to take a look at some specific tools that we can use to apply to the charts of financial markets to help us in identifying deep pools of liquidity and also high probability areas for market manipulation. We'll be taking a look at the Fibonacci retracement, the pivot point, and also the moving average tools. Now, although all three of them are very useful when used as standalone methods of identifying possible areas, their true power is demonstrated when they are combined with the previous levels that we looked at, which are the previous and current day's highs and lows. So the first tool we're going to take a look at is Fibonacci retracements. So the plotting of Fibonacci internal and external retracement levels of prior swing points is a very visual and popular form of support and resistance trading, and I'm sure that many of you have seen throughout this site that we specialize in Fibonacci trading, and we also have a very advanced course in Fibonacci trading. Now, retail and institutional traders look to these ratios as areas where future major or minor trend reversals or continuations can take place. Okay, so Fibonacci retracements are used by both institutional and retail traders, and they are used as horizontal levels of support or resistance, which are joined from one swing high to one swing low, or from a swing low to a swing high, depending on the market. Now, retail orders will tend to build up around these horizontal support and resistance levels, especially the 50% and the 0.618 internal retracement of a prior trend. Okay, so there are many Fibonacci ratios out there, and there's many ratios that can be derived from the Fibonacci sequence, but in terms of what is widely taught, both the 50% and also the 618 internal retracement are very popular, and because of this fact, many breakout traders and also support and resistance traders will look towards these levels for breaks and also bounces. So Fibonacci ratios are most powerful when they fall within a relatively narrow price range to one or multiple support and resistance zones. So as said in the introduction, these tools show their power when they are combined with other technical levels. So if we see a Fibonacci ratio and a previous day's high or low, or a current day's high or low, come together within a narrow range, this will generally create a lot of interest in terms of retail traders, and we will see a build up of orders. So retail orders and potential deep pools of liquidity will tend to build up in the area. So the plotting the Fibonacci internal retracements from the previous day's high and low and looking for areas of confluence will highlight high probability manipulation areas for the following day, as retail traders are drawn to these zones. So the simple process behind applying the Fibonacci retracements is we're going to look at the high and low range of the previous day's trading session. We're going to use these range or these swing points to anchor our Fibonacci internal retracements, and then we're going to look for a confluence with other technical levels for the current day's trading session. Okay, so it is very simple and straightforward. We simply need the high and low of the previous day's session. We're going to plot our Fibonacci ratios, and for the current day's trading, look for a confluence of technical levels within a relatively narrow range. Okay, so when we apply Fibonacci ratios to the intraday chart, we're simply going to use the high and low, or the low and the high of the previous day's session. So in this previous example, where we already have the low of the day and also the high of the day marked out, we're simply going to take our Fibonacci tool and we're going to click from the high right down to the low. Okay, and then this plots our Fibonacci ratios. So we have our 0.236, our 0.382, our 50%, and we also have our 0.618. So coming into the current day's trading session, we can see the accumulation taking place, and what we want to look for is a penetration of one of the ratios, inducing retail traders into the market and then selling into this buying pressure, because the Fibonacci ratios act in exactly the same way as the horizontal, the previous day's high and low, and also the current day high and low levels. Okay, all four of them are horizontal support and resistance levels. So if we move forward, we see that the 0.382 internal retracement, the market is pushed through the level, quickly rejected, and then the trend unfolds. Okay, so if we take a look at what has happened here in terms of the traders of different schools of thought. So if I get rid of the internal retracements, and as we know, going into the agent session for the day, we'll be looking for horizontal support and resistance levels first, and then we will be applying our Fibonacci ratios and any other tools after. So if I take a horizontal tool and we mark out first the high of the agent session, and then we're going to look for any obvious support and resistance levels, and we scroll over, and the same point has been penetrated. So the second horizontal zone that we had identified was penetrated, rejected, and the trend unfolded. So whether you are a Fibonacci trader or whether you are a horizontal support and resistance trader, and you look for breakout opportunities or you place stop loss levels in and above these regions, you're both going to be manipulated out of the market. Okay, so I will apply the fib tool back from the high to the low of the previous day's session, and we can clearly see that we have an overlap of the Japanese highs with the 0.236, and we also have an overlap of the second horizontal zone with the 0.382 internal retracement. Okay, so this is why when two of the levels fall within a relatively narrow range, we can expect deep pools of liquidity and a high probability level for manipulation. In the second example, we're looking at a first phase in a bullish market. So on the current day's trading, we're going to be looking for the manipulation and induction of sell orders into the market, so smart money can buy into this pressure and unfold the second part of the cycle. So in terms of applying Fibonacci ratios for potential levels for the following day, we'll simply take our tool and we're going to go from our low to our high of the previous day session. And again, this plots our Fibonacci internal retracements, our 236, 382, 50% and 0.618. So these horizontal zones will be constantly looked at by institutional retail traders who use Fibonacci analysis, and they will be looking for a penetration of these levels for breakout opportunities or a touch of the levels for a bounce. So if we move the market on for the current day's trading session, and bang, we can see that the market makers move the price action against their intended direction, and look where they penetrate. They penetrate the 0.618 internal retracement of the previous day's range. So any Fibonacci trader who was watching the 0.618, once they saw the level break, would have sold into this market allowing smart money to absorb this and push the market to the upside. Okay, so it's the exact same process as with the other horizontal levels. If we go back to the previous day and we mark out the obvious support and resistance levels for the current day, so we would have the support of the Japanese session, and then we would also have the highs of the previous day's Japanese session. And straight away, if we look at the previous day's Japanese session highs, we can see that this overlaps with the 0.618 internal retracement. Okay, so at this level of 0.7925, we have a confluence of technical indicators. We have a horizontal level, and we have our Fibonacci internal retracement. So we have orders building up of traders of two different schools of thought, and institutional traders will be aware of this. They push prices through and they absorb the orders. Now, of all the technical tools that retail traders have at their disposal, moving averages by far have to be one of the most popular. Now, in terms of the way they behave, the process in which smart money manipulates moving averages is exactly the same as for Fibonacci internal retracements and the other horizontal levels we have looked at. The only difference with moving averages is that they're dynamic in the sense that they move along with price. So, moving averages are floating support and resistance levels that retail traders use for direction, momentum, breakout trades and bounces. The 50 and the 200 moving averages are very popular and are watched closely by retail and professional traders. Now, in terms of intraday trading, we would generally have both the 50 and the 200 moving average on our charts. The 200 moving average is by far more of an interest to institutional traders, and many major trend reversals and also manipulation of orders will take place in and around this level. Now, moving averages are not static support and resistance levels, which means the build-up and manipulation of retail orders takes place when price action approaches or crosses a significant average. Smart money will push prices through a moving average to absorb the buying or selling of breakout traders, and then aggressively pull prices back, resulting in pins to the up or the downside. So again, no different to the previous levels of manipulation that we have looked at. With moving averages, where many retail traders, in fact the majority of retail traders will have them on their charts, they are also taught that these are levels of support and resistance. So the same opportunities and the same trading strategies will be taught in and around the 50, the 100 and also the 200 moving average. So many times you will see the professionals trying to induce retail traders into the market by throwing pins just through the levels and then aggressively pulling them back. So just like with the Fibonacci internal retracements, when the 50 or the 200 moving average overlaps or is close to static horizontal support and resistance levels, deep pools of liquidity may develop in the area. And just to stress again, the more of these manipulation levels that fall within a relatively narrow price range to each other, the deeper the pool of liquidity that is likely to build up, and the higher the probability of manipulation taking place in and around the area. In this first example, we're looking at the euro dollar, and I've plotted both the 50 and the 200 moving average. So the blue line represents the 200 moving average and the red line represents the 50. So during this session, after the Asian session accumulation period and the move against the intended direction, we can clearly see that price was run through the 200 moving average and then quickly rejected. So in exactly the same way that we see the highs of the Asian session or horizontal levels penetrated in this way, smart money are aware that these same strategies are taught for moving averages. Okay, so once smart money penetrates the 200 moving average, there will be retail traders who will begin buying into the market. You also will have traders who sold during the Asian session, having their buy stops placed just above the moving average. So as prices run through this level, this takes the stops out of the market and also induces traders into the wrong side. So in terms of aligning with other technical levels, if we mark out the high of the current day session, and then if we add our Fibonacci ratios to the low and the high of the previous day session, we can see that we have three levels come together within a relatively narrow range. Okay, we have the highs of the Asian session represented by the black line. We also have the 0.236 internal retracement of the previous day's low to high session, and we also have the 200 moving average. Okay, so we have three different technical levels falling together within a very tight range. So these are the areas that we will typically want to look for, and this will reinforce one horizontal level over another. Anytime you have two or more of these levels come together, we want to pay special attention to the area, because 9 out of 10 retail traders, whether they're from any of the schools of thought, whether they trade moving averages, horizontal support and resistance, or Fibonacci, will be aware of the area. In this next example, we're looking at the euro sterling, and again we can see clear signs of manipulation taking place around the 200 moving average. Now, one of the classic characteristics of the manipulation around moving averages is the pins to the up or the downside. If we look at the 200 moving average, we can see we have three clear pins which are thrown through the level, and as we know, this is to induce traders into the wrong side of the market and also to take out stops. Now, in this example, the manipulation and the move of the trend doesn't take place until the US session. We can see that they throw a hammer just through the level and price is quickly rejected, and then 15 minutes into the US session they throw the second pin, and then this pressure is sold into rapidly and we see a move to the downside. So the manipulation of moving averages can take place during the Asian, the London or the US session. Now, one thing to take note of is that during the manipulation of the 200 moving average, we see this classic M formation. Okay, so the M formation can take place during any manipulation of a level, and it's very often seen when they manipulate the 200, the 50 or the 100 moving average. Now, in regards to the alignment of other technical levels, if we scroll back and we again take our Fibonacci tool and we take the range, which is the high to low, and then we align the obvious support and resistance levels, and we scroll back, we can see that the 200 moving average and the alignment of the Fibonacci level and the low of the previous day's Japanese session all align within a relatively narrow price range. So we have the 0.618 internal retracement of the previous day's high to low. We have the black line, which is the low of the previous day's Japanese session, and we also have the 200 moving average, and this bar, which occurs just before the move, penetrates all three levels. So there's a guaranteed build up of retail orders in and around this level, as many retail traders will be watching the area. In this final example, we're looking at the US dollar versus the Canadian dollar, and we can see 2 points of manipulation through our moving averages. So the first manipulation takes place during the Japanese session, where we can see a pin thrown just below the 50, inducing traders into the wrong side of the market, and we can see a small uptrend take place just after the manipulation, and this leads into the open of the London session. Now, what they do here is very smart. As opposed to coming down and taking out the lows of the Japanese session so that they can unfold the uptrend, they simply bring the trend down to the middle of the range and they throw a pin through both of the moving averages. So if we take a close look at this pin here, it not only penetrates the 200 but also penetrates the 50 moving average. Now, whether you're a trader who primarily looks at the 50 or whether you're a trader who primarily looks at the 200, you're going to generally take action once you see one of these levels penetrated. And once smart money have absorbed the orders, we see a clear and strong uptrend take place. So again, guys, the manipulation of the moving averages can take place during any session. They are just as strong and just as reliable as our other technical levels. Now again, if we scroll back to look for any kind of alignment, we see we have a clear trend to the upside on the previous day, and we take our fib tool from the low to the high, and then we'll scroll back. Okay, so we have the 0.382 internal retracement, which falls within a relatively narrow range to the 50 moving average, and we can see that the pin that penetrated the 50 during the Asian session also penetrates the 0.382. Okay, so we have two technical levels which are taken out here, and then the same later on in the session, where we have the 0.236 and we have both the 50 and the 200 moving average. We can see that smart money throw the pin beyond all three technical levels, inducing traders into the wrong side of the market, whether you're a moving average trader or whether you trade fibs, and then snapping the market back aggressively and then unfolding the up trend. So moving averages are floating support and resistance levels, guys, and they are penetrated and manipulated exactly the same way as our other technical levels. The manipulation can take place during any of the three sessions, and it's very characteristic that you're going to see several pins to the high or to the low side which are aggressively snap back, and it's also not uncommon to see the W or M formation in and around the area of a significant moving average. Now, the next tool we're going to take a look at is one of my favorites, not only because it identifies high probability areas of market reversals, but also it can be used to reinforce and also confirm the decisions we make in regards to trade entry and also trade management. And the tool we're going to look at is the average daily range high and low marker. So the average daily range high and low marker is a powerful dynamic intraday support and resistance zone. Now, in terms of the average daily range, it's simply a measurement of the high to low or the low to high range, generally over a 14-day period, and they simply calculate an average. Now, in 9 out of 10 charting packages, the average daily range is generally represented in some kind of oscillated form. Now, in terms of practical use and highlighting areas of possible support and resistance, we've programmed this into a horizontal marker, and by doing so, this will give you highly visible areas where market reversals can take place. Now, the marker will automatically calculate and adjust the range once a new high or low for the day is set. Okay, so once the Japanese range is formed and we open into the London session, the marker, being dynamic, would adjust the range according to the low and also the high which is set. Now, the fact that smart money have a limit to the amount of pips that they can move a particular pair, and we learnt this in our first couple of sections, that they have limits imposed on them by the IMF, which only allows them to move a pair over a certain period, a certain amount. Now, during the day, if we're looking at the sterling against the dollar, for example, and we've calculated that there is a 80 pip daily range, then using the marker and by plotting this 80 point range, we can have highly visible and high probability targets where future market reversals can take place. Now, this is a very powerful and very useful tool for two reasons, and those being both trade management and also trade entry. So the position of the intraday trend in relation to a pair's ADR is a powerful trade entry and trade management filter, and should be used to reinforce and confirm your directional bias. Okay, so what do I mean by that? Well, if you can imagine you've entered a trade during the London session, and we know that the market generally moves in 3 legs or 3 phases, to the high and to the low, and we also know that smart money have limits imposed on them by the IMF, and that the average daily range is a representation as to how much they're moving a currency pair over a 14-day period. So if we've seen 3 intraday legs to the high, for example, and we've seen the average daily range for the currency pair being met or even penetrated, and then we're about to enter into the US session, the logical step would be for you to either exit the trade, tighten up your stops, and then look for a reversal during the New York session. Okay, because we've met 2 criterias and 2 technical filters that are telling us that the trend in which we are in is highly likely to end. Okay, and it would be the exact same in a bear market if we had taken a short during the London session and then we had seen 3 legs to the low, and the average daily range for the market had been penetrated or had been met, and we were about to enter into the New York session. Again, the logical step would be to either tighten up your stops, set your trade to break even, or exit the position, and then look for the New York reversal. And later on in the course, we're going to take a look at how the ADR and also the intraday trend can be used in combination with each other to allow us to identify if a New York reversal indeed is about to take place or a trend reversal. But that's something we're going to take a look at a bit later in the course. So the ADR high and low can act as a high probability target once a trade has been entered. So again, if you've entered a trade to the long and to the short side, and you see the ADR approaching, it may be a good time to start implementing some trade management to the position, or maybe even exit the trade. And again, the great advantage of having the ADR represented as a horizontal lines on your chart is that you have hard, highly visible price targets in which you can prepare for well in advance your trade management decisions. Now, just like with all the indicators that we've taken a look at in this section, when the ADR aligns with other support and resistance zones, high probability areas where the trading days high and low will form can be identified. So the last technical tool we're going to look at that is very often manipulated by the banks are the very popular pivot points. So much like Fibonacci retracements, pivot points are closely watched, highly visible support and resistance levels that smart money use to manipulate retail traders. Daily highs and lows, false breaks to absorb orders, M&W formations are very often seen at these levels. Pivot points like Fibonacci retracements are most useful when they fall within a relatively narrow price range to one or other multiple support and resistance zones. Retail traders and potential deep pools of liquidity will tend to build up in the area. So pivot points, guys, are no different to any of the other horizontal support and resistance lines that we've looked at. They're very popular, not only as a trading strategy, but also as a point of reference for price action. Many traders will look at pivot points, especially the central pivot point, and there are many strategies based around the breaking of this line. So smart money, being aware of the multiple and various strategies which are centered around pivot points, have incorporated this into their business plan and will very often manipulate these levels to again induce traders into the wrong side of the market and also to take out stops. Okay, in this example we're looking at the pound against the US dollar, and I've plotted the pivot points for the current day's session. So we have the central pivot point at 165.71, and then we have the mid and also the resistance and support ranges accompanying it. So in this example we can see that the high of the Japanese session has been violated, inducing traders into the wrong side of the market, but at the same time they have also pushed prices through the R1 or resistance 1 point of the pivots. Okay, so we have a confluence of two technical indicators coming together within a relatively narrow price range. We have the high of the Japanese range at 166.03, and we have the R1 of our pivot points at 166.06. So the same process will be taking place. Those traders who generally trade pivot points and look for breakout opportunities once a level have been penetrated will be buying into this market, and then smart money quickly snap the market away and then move the trend to the downside. Now what's interesting in this case is as the trend to the downside unfolds and smart money push prices towards the central pivot point, we can see that again they throw a hammer through the central pivot point, which of all the pivot point levels is the most popular, and this again has taken out the low of the Japanese session also. So again we have two technical levels falling within a relatively narrow price range, and smart money will absorb these orders and then begin pushing the price to the upside. So no difference in terms of the process. We have a low to high session on the previous day, so we'll mark our Fibonacci points from the low to the high, and we'll scroll across, and on the central pivot point and the Japanese low of the day, we have the 50% fib of the previous day's range overlap with both of the levels. Okay, so in terms of the retail traders that will be watching this level, we will have pivot point traders, we will have horizontal support and resistance traders, and also Fibonacci traders. So in and around this level, we will be paying special attention to, as the probability of deep liquidity building up from retail orders is high. In this next example, we're looking at the euro dollar, and again I've plotted the daily pivot points for the current day's trading, and we have the central pivot point coming at 131.866. So if I mark off the Asian highs, we can see that both the current day's Asian highs and also the central pivot point fall together within a relatively narrow price range. We also have the 200 moving average that's trading very close to the Asian high. So in terms of the formations that you will tend to see in and around these levels, or the central pivot point, we have that M formation which takes place. Before we see price ultimately move to the downside. So again, when we have those confluence of multiple technical levels, in this example we had the central pivot point, the highs of the Asian session, and also the 200 moving average, we will always expect to see deep pools of liquidity and the possibility of manipulation. Okay, so you've learned that the confluence of multiple static or floating support and resistance levels are areas of potential deep liquidity, and we know that smart money will want to push prices to these levels, accumulate orders, and also execute their trade. So the more of the technical levels that we've looked over that come together within a relatively narrow price range, the stronger the chances of manipulation taking place in and around this level. Now, an identified potential manipulation zone must be put in context with the smart money trend. So anytime we look for manipulation zones, we always want to be in line with the overall smart money trend. So there's a few questions you can ask yourself when you're looking at a zone, and that is, what is the count? Okay, where are we in the cycle? So if we're in phase 2 of the cycle and we're looking for the third phase to say the upside, then we know on the third day we're going to be looking for the manipulation of sellers into the market, so smart money can buy into this pressure and finish the last phase of the cycle. So you want to be asking yourself, am I expecting a stop hunt to the down or the upside, which we just covered in that last example? Am I in level 3? Am I looking for potential zones on both sides? So as we covered in our section on level 3 accumulation, when there is no cycle, and we've seen that sideways price action over the course of 2 to 3 days, we're going to be looking to trade both sides of the market. So in general, when you're identifying manipulation levels, it must be put in context with the overall smart money trend. So the most important aspect of identifying potential manipulation levels is to keep it simple, and that is probably the most important point in the whole of this section. Many people like to overcomplicate the process. It's very simple. Once you've plotted your technical levels, either they are aligning or they are not. Okay, nobody knows exactly where they're going to manipulate, but if we keep it simple and we identify areas of confluence, then the probability of manipulation is greatly increased. So just keep it simple and keep it as straightforward as possible. So the individual components we have covered in this section are obvious and highly visual. So again, we need to ask ourselves, are there two or more support and resistance levels which fall within a relatively narrow price range? Now, this is something that can reinforce or confirm one horizontal level over another. So if you start your process by identifying the obvious support and resistance levels from the previous day, we might be looking at, say, some swing highs or lows, or the high or low of the US session or the high or low of the Japanese session, and you find yourself with 3 or 4 horizontal levels on your current day's trading, then the lines that fall within relatively narrow proximity to another support and resistance level is an area you may want to pay special attention to. So it's a way of filtering the potential zones you have identified. Another important question is, does the potential area you are looking at have evidence of prior manipulation? Because if they've manipulated the market at a particular area once, they're highly likely to do it again, because it's a proven zone that they're aware retail traders have previously built up orders around and are likely to do so again. So once you've identified a level, check whether it falls within a relatively narrow price range to other technical levels, and then you want to look back to see if manipulation has taken place in and around the area before. Now, one final point, and that is to think like a professional. So when you're looking at the charts and you're trying to identify your levels, the best thing to ask yourself is, where are the obvious areas on the chart that the average retail trader will be looking at? And if you take this approach when you're identifying your manipulation levels, you'll generally find that the potential areas are very obvious, and the professional traders will be looking at these areas for areas that they can take advantage of the build up of retail orders.